Okay, welcome to the June 21st edition of the Fats, Fuels, and Oils webinar. This week, yesterday was a markets holiday, and so we were off, and as a result, I am running behind and publishing the report, so the new report isn't out. I'm going to try and get it out today. It may go out either late tonight or maybe even as late as early tomorrow morning. I've gotten most of the data updated. It's just a matter of doing the writing. So apologize for the delay, but I took full advantage of the long weekend. Over the past week, we saw a pretty sharp drop in veg oil prices. Part of that is the seasonal progression, I think, is the very minor part of that, because that certainly doesn't account for the rate of the decline. Soybean oil futures lost 7 cents last week, and cash prices were down a little bit less than that, but not much. And so typically, if it was just a seasonal decline, you wouldn't expect it to just drop off a cliff like that. I think the spread between soybean oil and palm oil has blown out to around 20 cents. And so now I think it's kind of fair to say that the palm oil market, which has dropped even more than soybean oil, or I guess maybe the same amount in percentages after you've adjusted for currency, given that the spreads have been kind of steady or maybe risen a little bit. But the sharp decline in palm oil, I think, is really sort of what's driving the move in soybean oil. I think it's hard for the spread to go much higher because the higher that spread goes, the less attractive soybean oil is in the export market, and the export market needs soybean oil, although maybe not. And so that gets down to why is palm oil suddenly turned around and fallen so sharply. And I think there's probably a couple reasons for that. I think probably the primary driver is when you've had a return of the Indonesian or lifting of the ban on Indonesian exports. That's not new news, obviously, but they kind of slow rolled it out, and then they've accelerated it. And so I think that last week was probably the first week where the market got a good sense of what the new program would look like and what that would mean for export volumes out of Indonesia. As a result of that, Malaysian palm oil shipments during the first 20 days were down about 10% relative to the same period in May. And I think that, so I think all of that is a little bearish. Again, probably it's not necessarily new news, and probably one of the minor contributors. I think probably one of the bigger contributors has been the rebound in Malaysian palm oil production. So estimates for the first 15 days suggested that palm oil production was going to rise 50% month over month. Now, that doesn't mean that it's going to end up 50% above, but palm oil production in Malaysia has been running sort of below or near, at the very least, near the lower end of the historical range, based on the time of the year. So typically we see palm oil production bottom out in February or March, and then it kind of rises through the year and then peaks in September and October. We saw the bottom a little earlier this year, and then we saw the sort of pretty much the typical seasonal increase. And then last month we saw basically kind of flattish production. And so I think that, combined with the Indonesian ban, had lifted palm oil prices to a level that was unsustainable if any of those things changed, obviously, since palm oil prices have fallen. And so I think that part is maybe the straw that broke the camel's back. concerns about global economic growth and a global recession. You can probably throw that in there as well. I'm not sure that I think that that's a huge contributor, though, given that the world is sort of structurally short vegetable oil. I would think that even if the market expected a global slowdown, that that the impact wouldn't be that significant. So I think the bulk of it really is this idea that Malaysian production is probably going to come back, and it's been something that the market has been waiting on for quite a while. And so I think that Malaysian prices at least will probably be in charge of soybean oil futures in the relatively short term. Um, on top of that, you've had a good start to the U.S. growing season. The initial crop ratings for soybeans were above last year. We've had a little bit drier weather, and for a while the outlook was for sort of hot and dry, which is the big fear. But today's 6 to 10 day outlook shows cooler than normal temperatures over a lot of the Midwest, although it still features below normal precip for a lot of the Midwest in the 6 to 10 day, and then mostly the Eastern Corn Belt in the 8 to 14 day. And so I think that even though that dryness and potential heat may become a concern later on in the growing season, after the cold and wet spring that we had, some heat and some dryness is sort of exactly what the crop needs. And so I think all of that combined has contributed to the sharp sell-off. And then once you get prices rolling in a direction, particularly as quickly as they have fallen off, you start to get profit taking and just position liquidation due to margin calls or whatever. And so you get that sharp move down. I don't think that I think we're probably at the lower end of the trading range right now. Again, a bit of that will depend on what palm oil does and what the production estimates look like over the balance of the month. But if you look back through the rally that we've seen in soybean oil off the pandemic lows, you've kind of tested the 100-day moving average a couple of times. One time you moved kind of significantly below it there after last summer's peak, I think, during the fall last year, if memory serves. But when you have dropped below that 100-day, then generally that has marked the end of the sell-off, and prices either stabilize or start to come back. The question here is whether demand is going to be strong enough to get prices to come back, or we go down towards what we think is sort of the longer term fair value for soybean oil. Right now, biodiesel margins are as high as they've been in a long time. I was chatting with Bob Lane about it earlier today, and he was asking how far back my margin calculations go, and he said his goes back to 2017. Margins were at the highest that he had seen in his data. I suggested that there was maybe a time in 2014 when oil prices were above 100 and soybean oil prices were around 40 cents, that margins might have been a little bit better, but RIN prices probably weren't quite as high then either. So either way, it doesn't seem like you're going to get a lot of relief on the domestic side from the renewable fuels industry. And this week, our profit margin estimates actually showed a big jump in biodiesel profitability. It went from negative 12 cents up to positive 12 cents, or negative 16 cents up to positive 12 cents. Renewable diesel moved the other way, but off just slightly. And the big gain in biodiesel obviously was due to the drop in soybean oil prices, while for fats and grease prices, we saw mostly steady or slightly higher prices. I think going forward, the moves in fats and greases may become increasingly disconnected from the moves in soybean oil. If you think that the fat and grease supply is relatively fixed, and you've got all of this demand coming at the market, supply is not able to adjust in fats and greases like it theoretically can in vegetable oils, and every new renewable diesel plant that comes online wants to use fats and greases as feedstock so that they can maximize the value of their LCFS credits. And so we may have a situation where soybean oil prices start to drop and fat and grease prices remain at or close to record levels. I'm not 100% sure that I think that that's what's going to happen. I just am not sure that we're there yet completely for renewable diesel demand. But I think that we will get there probably before the end of the year. I think we probably are going to get to a level where we're starting to really press the supply of fats and greases relative to what's available to the bio mass-based diesel industry. So given all of that, we still think in the longer term that that soybean oil prices have set their highs for the year. That's obviously a lot easier to say today, but that doesn't mean that prices can't bounce from here. I don't think that this move lower is probably sustainable. I think it probably, we're getting very oversold, and we probably have a bounce and then kind of slowly work our way lower through the end of the summer as we understand more and more about what's going on with the US crop. That said, the old adage that commodity markets take stairs up and elevators down suggests that if this is sort of the correction to the long run sort of equilibrium, that that you would expect to see prices continue to move lower and then kind of stabilize. Again, I think probably somewhere around 65 cents. Given the ranges that we've seen, I'd probably put a fairly wide range around that, but that would sort of be my midpoint. We also got our EMTS data for May. And well, first we got NOPA Crush. NOPA Crush came in stronger than expected, and it was in soybean oil, ending stocks came in at about 1.9 billion pounds. Given the stronger than expected crush, the 1.9 billion pounds was actually about where you would expect, and actually suggests that that domestic demand remained pretty strong, just based on our assumptions for imports and exports, and the assumption of the difference between the NOPA data and the USDA data suggests that domestic demand rose to almost 2.4 billion pounds. That probably is the upper end of what domestic usage was, but it suggests that either way, I don't think it's off by 500 million pounds. I think it's probably off by maybe 100 or 200 million at the most. And the average for the year so far has been just over 2 billion pounds. And so a lot of that strength, in theory, again, based on our prediction for biomass-based diesel demand, came from non-bio demand. And so we estimate non-bio demand was probably about 1.2 billion pounds in May. And that would be very much in line with the um, monthly totals that we've seen so far throughout 21, 22. And it ultimately means that we probably are going to have to raise our forecast for non-biofuel demand from 13.25 maybe up to about 13.5. We probably won't have to raise it too much, and I think ultimately USDA is going to need to come down as long as monthly non-bio stays in sort of the 1.1 billion pounds per month range. Then it looks to me like it's going to be a lot closer to 13.5 or maybe even 13.75 than it is to USDA's June estimates. All right, so we got that. The EMTS data showed that biodiesel production, domestic biodiesel production, totaled about 140 million gallons. That was down about 4 million gallons from last month. And it was, excuse me, I'm kind of sliding around a spreadsheet here. It was about 4 million gallons below our expectation. Despite the fact that we were lower than expected, we actually added about 50 million gallons of production to biodiesel because we reduced our forecast for renewable diesel. Because renewable diesel domestic production came in at 136 million pounds, which were 136 million gallons, which was about 6 million gallons below our forecast. And so just based on what that looks like and what that made the rest of the year look like, based on the typical seasonal projection or typical seasonal pattern, and the expected capacity build out that we see over the rest of the year, we took about 65 million gallons out of renewable diesel. That makes the numbers look good right now on a month-to-month basis going forward. If there is an extra or there isn't an extra renewable diesel plant over the next 6 months, then that will make a big difference in what that total ultimately is. And so we do our best to keep up with that, and we think we've got a fairly good handle on when renewable diesel plants are going to open. But any change in that or any deviation from our expectations at this point can have a pretty significant impact on our forecasts, and this month was kind of demonstrates that. We still expect renewable diesel production to more than double from 845 million gallons last year to now we're at 1.85 billion gallons. So it's not like we don't expect big growth. It's just that we were a little bit more aggressive last month. And for biodiesel, that change means that now we expect actually biodiesel production to be up month or year over year from just over 17 billion gallons last year to 1.7 billion gallons last year to 1.73 billion this year. I guess 1.71 to 1.73 this year. Again, I think that the two gaps that we've talked about so much, the gap between the total mandate and everything that falls under D5 plus, or the D5 mandate and everything that falls under it, and plus Brazilian ethanol imports, that kind of that contributes a lot. And then the gap between ethanol production and the ethanol mandate also remains pretty substantial. And so we think that again probably provides enough support and economic incentive, more importantly, for biodiesel producers to remain in business through the end of at least this year. There's probably also a better chance that they'll remain open at least through part of next year. And I think that the next several months will tell us a lot about what biodiesel production in 2023 looks like, um, given the fact that we will add a significant amount of new renewable diesel capacity. If biodiesel can continue to produce at, call it 140 or 150 million gallons per month, then on average over the whole year, then next year's production could probably be pretty close to that 1.7 billion gallon number, and we probably would raise it from right now we're at 1.39. But again, that'll kind of depend on what happens over the next several months and the reaction in biodiesel margins um, to the increase in renewable diesel capacity. The only other thing about the MTS data is that ethanol production came in pretty close to our forecast. And so that just means that the gap there between ethanol production, or our expected ethanol production, and the ethanol mandate didn't change this month. We're still kind of expecting that ethanol production will be in the 14.4 billion gallon range, versus a mandate of 15.25. And so again, that gap needs to be made up from someplace. On the credit forecasts, and again, apologize that I don't have charts to show you on all of this stuff. Our RIN forecast came down a little bit this week because RIN prices moved a little bit lower. The spread stayed relatively narrow. The spread is between D4 and D6 is still at like $15. And so we still expect that spread to tighten and that to support RIN prices over the balance of the year. But I think that if soybean oil prices stabilize around here or start to move back higher again, that's sort of one RIN level. If they move down to 65 cents, that's another RIN level. I think that if you adjust those levels, the thing that you probably don't adjust is the spread between D4 and D6. I still think that because of that gap in ethanol production, that sort of continues to narrow as we go through the year. Part of the reason that that RIN prices moved lower is likely the sharp drop in vegetable oil prices, and to the extent that the function of the RIN is to sort of cover the changes in profitability implied by feedstock costs, then the drop in vegetable oil prices played a significant role in RIN prices. LCFS credit prices seem to have stabilized around $80. Now, this will be the third time I think that I've said that I think that they've stabilized. I think the first was 150 and the second was 115. And now it looks like for the past couple of weeks, they kind of traded around 80, dipped into the 70s there, I think, for a second, and then have started to recover again. And so we modified our RIN or our LCFS forecast to make it sort of relatively flat, around 80 for the next year. And that includes the beginning of 2023. As we wrapped up our adjustments to our forecast for LCFS production and more importantly, LCFS credit generation versus deficit generation for 2023. One of the surprising things that came out this quarter is that it looks like credit generation probably continues to exceed deficit generation by through 2023 and through 2024. This means that it probably is likely tough for LCFS credit prices to rally much. And we adjusted our long-term forecast to reflect that. But it also means that our short-term forecast probably is going to continue to be relatively flat at whatever the level is that we're at now. There is still a possibility that CARB comes in and does something so that LCFS credit prices rise. But I think that given the amount of renewable fuel that the California market is attracting, I think that they probably think the program is a success, and the low credit prices will find their equilibrium where renewable diesel producers will decide how much to ship into the market based on the credits, and that kind of all of that will balance. Now, I say that today, and tomorrow CARB will probably come out with an announcement about changing the way that the deficits are generated or the credits are generated to get credit prices back up. But until that happens, I think it's probably fair to say that our LCFS credit price forecast is going to be pretty flat going forward, unless there's something that makes us think that either prices are going to head much lower, which at this point would just be lower prices, or if there's a change or something, and we have to adjust that credit generation and deficit generation forecast, and those become closer in balance. Outside of that, really the only other news the only other recent news was the announcement by Argentina that they were going to raise their biodiesel mandate back up to 7.5% for the next, I think, 90 days, 60 or 90 days. I think it was 90 days. The Argentina recently passed a law, and they had, well, initially in 2021, they had taken their mandate down from 10% to 5% or lower, and effectively I think it became sort of 2 or 3%. And then they were going to pass another law that would sort of cap it around 5% because of concerns about the vegetable oil shortage in the world, and they wanted to make sure that there was vegetable oil available to both the domestic market and to the export market, because it's a significant source of foreign reserves for the government. Now there are concerns about fuel supplies, and so that's why they raised the mandate, so that fuel supplies aren't as short as they might have otherwise been, given the reduction in biodiesel production that the lower mandates implied. That is not having a huge impact hasn't really had a huge impact on vegetable oil prices, and it's not a huge change in the overall demand for Argentine vegetable oil. I don't have the numbers in front of me, but it's a relatively, their biodiesel production is relatively minor compared to domestic consumption, or even more importantly, exports is the biggest use of Argentine soybean oil. So it's not like all of a sudden this is another very bullish thing in world fundamentals that you can point to and say, oh, this is what soybean oil prices are going to turn around on. However, it is something that is changed, and it does mean that there will be a little bit less soybean oil available to the world market, and that means that, again, that the world probably needs U.S. soybean oil exports. And so they may be a little bit stronger through the end of the year than we're expecting. We're at like 1.7 billion pounds. We've seen a bit of a slowdown in the weekly export sales data. And if you look at export commitments, which are export sales plus export shipments, if you look at commitments, we're very much sort of tracking the same pattern that we saw last year, where exports jumped during the first part of the year when shortly after harvest when basis is relatively low, but then kind of flattened out as we went through the year as basis kind of rose. And Gulf basis has been relatively strong. All basis has been relatively strong, both for the export market and the domestic market. And that probably is going to continue in the short term, although I think refining margins probably come under a little bit of pressure as we get into the third and fourth quarter of 2022, and you get more renewable diesel plants opening with pretreatment capacities. So right now, and like I think I've said before on this call, what we're hearing is that a lot of the new renewable diesel plants are opening but with pretreatment, but they're using RB or RBD soybean oil to ensure that they have enough supply while they get on top of the pretreatment learning curve. And as that starts to go away, I would assume that to the extent it's possible, they will reduce soybean oil purchases and increase fat and grease purchases. And so I think ultimately that will kind of pressure refining margins a bit in the third and the fourth quarter. I don't think it's going to be a big drop off. I don't think that we go back to the long run average, which is around 3 cents or so. But I do think that refining margins could get down to maybe 18 cents, 19 cents, 17 cents, somewhere in there, from around 22 cents or 23 cents right now. So I think that there probably will be a little bit of relief for end users of RBD or RB soybean oil during that time frame, but in the short term, I think it still is that that basis is still being supported by this demand from new renewable diesel plants that are not quite up on their pretreatment capabilities quite yet. All right, with that, I will open it up for any questions, and if not, we'll finish relatively close to our blocked time. All right, I don't see anybody. So thank you everybody for coming. Again, apologies that we haven't gotten the report up yet. I will try to get it up today, but it may be tomorrow morning before everything gets together and gets published. And so sorry for any inconvenience, and have a great week. And I will see you all back here next week.